The Simple Path to Wealth is a personal finance and investing book written by J.L. Collins, an investor, writer, and financial educator best known for explaining long-term wealth building in the simplest possible terms. J.L. Collins is not a Wall Street analyst, hedge fund manager, or professional trader. In real life, he made his money through steady investing and a long-term mindset rather than complex financial strategies. The book itself began as a series of letters Collins wrote to his daughter, explaining how money, investing, and financial independence actually work in the real world. His goal was not to impress her with technical knowledge, but to protect her from confusion, bad advice, and financial traps. Over time, those letters evolved into a blog and eventually into The Simple Path to Wealth. What makes this book different from most investing books is its intentional simplicity. Collins argues that the financial world is deliberately made to feel complicated so that people feel dependent on advisors, products, and institutions. Instead of promoting stock picking, market timing, or complex portfolios, he focuses on a straightforward approach built around low-cost index investing, long-term thinking, and avoiding unnecessary risk. The book is written for people who want financial independence without turning investing into a second job. It does not promise quick riches or shortcuts. Its central claim is that wealth building does not need to be complicated, stressful, or time-consuming. By understanding how markets work, avoiding common mistakes, and staying consistent, ordinary people can build extraordinary financial security over time. In The Simple Path to Wealth, J.L. Collins begins by challenging the idea that investing must be complicated in order to be effective. He explains that the financial industry benefits from complexity because confusion creates dependence. When people feel overwhelmed by investing jargon, charts, and products, they are more likely to hand control of their money to advisors, fund managers, and institutions that profit from fees. Collins argues that most people do not fail financially because they lack intelligence, but because they are exposed to bad advice and unnecessary complexity. The book emphasizes that investing success is not about brilliance or prediction, but about behavior. Emotional decisions, fear during market downturns, and chasing performance cause far more damage than lack of knowledge. Collins repeatedly reinforces that markets will rise and fall, but over long periods they have historically moved upward. Trying to predict short-term movements is not only unnecessary but harmful. He criticizes strategies based on timing the market, picking individual stocks, or reacting to financial news. According to the book, these approaches increase risk without increasing long-term returns. Instead, Collins advocates for owning the entire market through broad, low-cost index funds. This allows investors to benefit from overall economic growth without betting on individual companies or trends. The simplicity of this approach is intentional. By removing decision-making complexity, investors are less likely to panic or interfere with their own success. Collins stresses that investing should be boring. If investing feels exciting, dramatic, or stressful, something is probably wrong. The goal is not entertainment, but consistency. The book frames simplicity as a form of protection from fear, from manipulation, and from costly mistakes. A core pillar of The Simple Path to Wealth is J.L. Collins' strong advocacy for low-cost index funds, particularly total stock market funds. He explains that an index fund allows an investor to own a small piece of thousands of companies at once, spreading risk across the entire economy. Rather than trying to guess which companies will succeed, index investors benefit from the overall growth of business itself. Collins emphasizes that fees matter far more than most people realize. Even small percentage fees, when compounded over decades, can consume a massive portion of returns. This is why he strongly discourages high-fee mutual funds, actively managed portfolios, and unnecessary financial products. According to the book, most professional fund managers fail to outperform the market over long periods, yet still collect fees regardless of performance. Collins presents index investing as a way to remove both ego and guesswork from investing. Once money is invested regularly into broad index funds, the main job of the investor is to stay the course. The book repeatedly stresses patience. Wealth is built slowly, through decades of consistent investing, not through bursts of brilliance. Collins also addresses volatility directly. He explains that market crashes are not failures of the system, but normal features of it. Investors who panic and sell during downturns lock in losses, while those who remain invested benefit when markets recover. By understanding this in advance, investors can mentally prepare for downturns instead of reacting emotionally. The book reframes volatility as the price paid for long-term growth. Without ups and downs, there would be no opportunity for returns. Index investing, combined with long-term commitment, allows investors to harness growth while minimizing unnecessary risk.
A key lesson in The Psychology of Money is the underestimated power of compounding combined with patience. Morgan Housel explains that compounding works best not when returns are extraordinary, but when they are consistent over long periods. Many people focus on trying to achieve high returns quickly, but the book argues that time is the most important ingredient in wealth building. Housel highlights that some of the most successful financial outcomes come from people who simply stayed invested for decades, allowing small gains to grow exponentially. The challenge is that compounding is unintuitive. Results are slow at first, which makes people impatient. This impatience often leads to abandoning strategies too early. The book stresses that consistency matters more than intensity. Someone who earns average returns over a long period can outperform someone who earns high returns briefly but fails to stay invested. Housel also emphasizes the importance of saving behavior. How much someone saves and how long they save it often matter more than picking the perfect investment. The book encourages aligning financial goals with realistic timelines, accepting that wealth is built gradually. This perspective reduces stress and discourages impulsive decisions. Housel ties patience to emotional control, explaining that the ability to endure boredom, uncertainty, and volatility is a competitive advantage. Many people fail not because their strategy is flawed, but because they cannot stick with it emotionally. Compounding rewards those who remain calm and disciplined over time. The lesson is clear. Time in the market, combined with good behavior, is more powerful than trying to outsmart the market.
The final message of The Simple Path to Wealth is that financial independence is achievable for ordinary people if they are willing to ignore noise and commit to simplicity. Collins emphasizes that most financial stress comes from uncertainty and overcomplication. By understanding a few core principles, spend less than you earn, invest the difference in low-cost index funds, avoid unnecessary debt, and stay invested for the long term, people can dramatically improve their financial outcomes. The book rejects the idea that investing requires constant attention or expertise. Instead, it presents investing as a background process that quietly supports life rather than dominating it. Collins also warns against the influence of fear-based media and financial marketing, which profit from convincing people that the future is unpredictable and dangerous. While uncertainty exists, long-term ownership of productive businesses has historically been one of the most reliable paths to wealth. The simple path is not exciting, but it is effective. The book closes by reinforcing that money is a tool, not a goal. Wealth is valuable because it creates options, flexibility, and peace of mind. Financial independence allows people to choose how they spend their time, not just how they spend their money. The simplicity of Collins' approach is not a limitation, it is its strength. By doing less, reacting less, and trusting long-term growth, investors can avoid most of the mistakes that derail financial progress. The book's final message is calm, steady, and reassuring. You do not need complexity to build wealth. You need patience, discipline, and the courage to stay the course.